I'm kicking us off here. I know no one's watching live yet, so this gives me the chance to welcome everybody to the replay. I'm super excited for the conversation we're about to have today. You might have seen the title, Lapse-Based Insurance. This is what everybody is afraid of, but they don't know to call it this. This is where you lose your life insurance. It's not there anymore. It's not working for you. It's not working for your beneficiaries. None of that. It's totally lapsed. We're going to share some statistics about how many policies lapse, what that looks like, how to make sure yours doesn't, what kind of life insurance is more likely to lapse or not likely to lapse, all those things. And why you should be really passionate about caring about this is it's your money. For you to pay all this money for something and then it lapses and you have nothing to show for it, that's a pretty big deal. That's like throwing money, in the fire, or buying fast food at McDonald's versus real wholesome meals. Going to have a very different impact on your financial future. So, I think that's my intro. Everybody's ready to go. So please join me in welcoming the one and only Mr. Mark Willis and the one and only Mr. Brandon Neely to the show. Welcome, dudes.
Hey, I got to do my zoom out here. Whenever I join Restream, it seems to like my face a little too much. Let me get a little bit better. There we go.
There we go.
Good to see you guys.
Good to see
Happy
you
afternoon.
too.
Happy Friday. We're living in fun days here.
Yes.
And a great intro. Thank you, Amanda.
Yeah. I always like to
this
make sure
topic
we
is-
start on time, and I welcome all the people that catch the replay. And
I
then
appreciate it.
now we'll get all the people jumping on live, and we'll have a great conversation.
Love it. Love it. Well, so you gave a great intro there. I think some of the stuff we're going to share today, I think, is very relevant. We're going to be having, I think, a very substantive discussion about something that can make a big difference in people's lives. Who was it who said, you said it, the best policy is the policy that's actually in force on the day you die. And you folks that follow us know pretty well that we are experts at a strategy called Bank on Yourself, which uses dividend paying whole life insurance. But that's only one of a number of different tools that are out there that kind of mimic or look like Bank on Yourself. There's a lot of knockoffs out there. So, Amanda, what do you think is our best kind of approach for folks that don't know what the heck, why in the world should you care about lapse-based insurance on a perfectly good Friday afternoon? Why does this matter? What's important about this to folks?
Yeah, what I would so if we're talking about insurance, what I'd invite people to do is imagine how you would feel if you got into a car accident and you called up your life insurance company, "Hey, I just had an accident. I need to file a claim." And they said, "Sorry, not sorry. Your coverage lapsed a couple days ago. You're not covered."
Yeah.
Right? Or like what a lot of people fear is they have something happen in their home and only to find out that whatever happened isn't covered under their policy, even if it's in force. Right? We can get into really big trouble if we have a mortgage and we let our homeowner's insurance lapse. So that's more unlikely to happen. But what about the claim process, and all those things? But then wouldn't you feel really upset if you had auto insurance or homeowner's insurance and you found that it was designed to not be there? That there was some kind of thing that when you needed it most, it would be lapsed. It would not be in force. That would really make me mad. I don't know about you, but when I think about insurance, a lot of people love to hate insurance. And yet we'd be really mad if it wasn't there when we needed it.
Right.
So Brandon, then let's apply that to life insurance.
That's right. Yeah. Yeah. I'll tell a story that kind of gets us, I think, right where you're going there, Amanda. Last fall, my dad died. And it was a kind of a shock. He had always struggled with his health for many years, but it was kind of a shock when it happened. It's always a shock, but it was sort of surprising. A few months before he passed away, I got an email from him saying that he was ready to let his term life insurance lapse. And, if we haven't already defined it, lapse just means stop the premium payments and let it just disappear. And with term insurance, you get nothing for it. You've just been renting the death benefit for some period of time. And when he told me that, he there was this moment where he said, well, I thought about maybe letting you take over the payments, but he had just kind of just decided before that to let it go. And
Mhm.
so, unfortunately, a month or two later, after he canceled or lapsed his life insurance, he had a stroke, and he became totally uninsurable, of course, at that point. And then 2 months later, he passed away. So, it's not. I'm not sure how long he had that term insurance, but I know he had sold health insurance and life insurance even back in the 80s. And he actually was a big part of the A.L. Williams push of buy term and invest the difference. But like many Americans, he only bought the term and he really never invested the rest, unfortunately for him and for me as the beneficiary, right? So he let that policy lapse, and there was nothing much else in the way of an inheritance because there was nothing much else invested. So I say all this not to make folks, think, whatever about me and my story, but to impose upon everybody watching this that it's a big deal how you handle the exit ramp of life. And particularly today for this conversation, the exit ramp of your life insurance policy. Like you said, the only policy that really counts is the one that's in force when you pass away. And for my dad, it was like many insurance. We're going to talk, I've got some statistics here. There's, most term insurance never pays a claim. It never pays out. It's in essence, it's free money to the insurance company, and it's a pure cost and loss to you. Some people think, well, whole life insurance is a big waste of money. What a bad rate of return. I would suppose that the worst rate of return is when you put money into something and get nothing out of it. That's called
Yeah.
a 100% loss. Brandon, go for it.
Well, I was thinking about when people ask about the rate of return on some of it and the tax-free advantages on specifically whole life insurance um, to the heirs, is that rate of return is pretty amazing. The problem is you just don't get to experience that amazing rate of return, but it's triple digits sometimes, like it's huge, that of how big of a rate of return it actually is. And if we really care about our family, wouldn't you want to give them that kind of rate of return tax free without any risks of anything? Like seriously, I'm like, but we always are thinking me centered, not about other centered, like um, that kind of way. So I think rate of return, people love that, but again, thinking about the Rockefellers and the dynastic trusts that people build and or want to build, and I'm like, well, that's what the rich have done, and they continue to do, and they're able to do a lot more because they think long range.
So let's talk about the lapse-based insurance, and then we'll come back to the kind that won't lapse and be there for your
Yeah,
family. So this term we actually stole from some awesome people at Wharton that wrote an article about insurance that lapse, Gottlieb and Smetlers, and they like gave us this language, lapse-based insurance. It's not a term we made up; it's a real term that's out there. And they gave us some stats like 70% of US families own life insurance, but the majority of those policies never like pay out the death benefit. Instead, either people voluntarily terminate them or they lose them because they miss a payment and the policy lapses and they never, reinstate it, and it goes, on and on. And that can happen especially for older people. I saw this one stat that you put in here, Mark, that especially for people over 65. Can you talk about that?
Give a bit more context because there's a bunch of stats I wrote
Oh yeah.
down. So help me out with
Um
which one you're looking at there.
yeah, number
Oh,
7.
I see it there. Yeah.
Okay.
Yeah. So this is according to Millimum USA, a research survey firm. They said almost 85% of term policies fail to pay a death claim. Woo!
wow.
Wow. 85%. And 88% of universal life policies ultimately don't terminate with a death benefit claim. What's that mean? That means they lapsed. That means nobody got the death benefit. That means you might have cashed out your policy and maybe got a few grand or something when you were 70 or something. So it's not saying that nobody got that it's a complete loss like term insurance is. But when 88%, basically 9 in 10 of your your backyard grills are failing, I call a recall. Okay? If 9 in 10 of your, pickup trucks are blowing up on the side of the highway, I would issue a recall. And yet we have statistics now from not just a small little rinky-dink firm. This is the Wharton School of Business out at UPenn, and some of the best researchers in the industry looking into this. And when 88% of a product line is failing to do the most fundamental part of what life insurance is there to do, pay a death benefit, when 88% has not paid that claim, that is a failure. I don't know what else to say. I mean, guys, walk me off the ledge here. Am I wrong? Am I overstating the case?
Yeah, we want to hear from you in the comments. Let us know that. And then so you have also this stat that comes from the Milliman research people too, that if seniors who buy a policy at age 65, so these aren't people that are buying policies to protect young children unless they have the grandchildren moved in with them. Those are probably seniors that want to make sure they're covering their final expenses, that they're taking care of their significant other, right? Like you would think they're buying this because they want the death benefit. If you're buying a policy at 65, that's a pretty big thing you're thinking about at that point. And yet it's still 74% of term policies and 76% of universal life policies never pay a claim. Even for that age group.
In the aged or elderly group,
Yeah.
even those high. Oh, wow. Well, why is that? What happens to term insurance, guys, as you get older?
It gets more expensive, and you can't afford to keep it because as you get older, if you're 95, one is they probably aren't going to insure you if you're trying to get a policy at 95 because of health or whatever and age. So they will not do it, or they'll charge you a lot of money for that. Because why would they just give you money at 95 just to say it's a business model, right?
Right.
They're not going to just say, oh yeah, here you go, and we're going to give your family 30,000 because we love you. Like, it's a business.
Mm-hmm.
The other thing I think about is when you're buying life insurance younger, maybe you will pay the premiums for longer because those premiums are smaller, right? Or you have maybe some reasons like those young kids that you see every single day reminding you how important that death benefit is. When you're older, if those premiums are higher, you're also, hopefully relaxing, traveling, those kind of things, you might be more likely to forget to pay the premium or to change bank accounts and not update the account information. Like as we get older, I hope I maintain all my mental faculties, but that's not always the case.
Yeah.
So, why do people lose hope, I guess, or why do they start out so well-intentioned with their term insurance or their universal life insurance? Nobody starts a life insurance policy to drop it with complete loss, I suppose. So what happens? What are the reasons? I mean, one of the reasons in the article was they call it an income shock, where there's an unexpected significant decrease or financial difficulty in the household. I think there's more to it than just that, but that's clear. If you can't afford the premiums anymore, then you can't keep the policy going. Now, someone once asked me, well, Mark, if I can't afford my premiums, how in the heck is my family going to afford the problem of me dying? Which was an aha moment for me when they said that.
Yeah.
If I can't afford the premiums now, how in the heck is my family going to afford the problem of me dying later on? Is a big question that folks don't often think. All they can see is the here and now. That term premium is getting to be annoying or expensive, especially as you age. And same true with universal life policies. I think there's income shocks there too. And folks just say, well, what the heck? I can't afford this thing anyway. And what good has it done me lately? Let's just cash the thing out, get my 10 grand or whatever is in there, and I'll go buy a nice used car with it or something. Are there other reasons why people start out with good intentions and then lapse their policies, guys?
Well, I think we're going to talk about this eventually, how Universal Life doesn't have a reduced paid up option.
What do you
So
mean
they
by
don't.
that? What is that? What does
Yeah,
that mean?
so that's where you can reduce the death benefit, and it's considered paid in full, reduced paid up. And some life insurance policies have that, the kind we use for banking yourself do, but Universal Life doesn't. And so if I'm have the option, right, like I just lost a job, let's say, and I've got this money sitting in my Universal Life policy, I might be scared to take a loan because I've always been taught debt's bad. I
Yep.
might I can't continue making the premiums and like, well, I'm just going to get that money out, and I can only think of withdrawals. I can't even think about reduced paid up and then still using it or anything like that. My options are more limited.
So I don't know if I can add this here, but I was just thinking about this and listening to why somebody would even set up those type of policies. And oftentimes they are glass half full. It's going to always be great. As long as you fund the premiums up to the max, it'll be fine. Right. And so people are optimistic. Right. And then we're sold that. But and this is even in sales on our side, is I want to show the amazing point, and I could, right? But there's all kinds of things that happen in life that are out of our control, right? I was just thinking about this recently. Is I don't know if you guys have felt this, but gas is a little more expensive than it was a year ago, and other things are. And so we want to control certain things. And if you're told, well, if you, as long as you fund it all the way and you never like use it the way it's sold, like for us, we use it for retirement income supplement, maybe, and other areas. But as long as you don't do that, we could show you what it could do, but don't do that. Just keep funding it, then it'll work out, right? And so people have done that. They think that that's it looks amazing. And you see a 40-year-old that I see some of their illustrations, and then I see a 70-year-old who's like, "Oh yeah, sorry, it didn't work out like I wanted, and I lowered it because we had COVID and I forgot about it. Now we're having a thing like inflation, and people are like, "Oh yeah, well I thought so. It looked great, and we forgot." Right. And
So,
so I think that that's a problem.
so have you guys ever tried to start a fire in the rain, like a campfire or anything? You
Well,
guys ever
we
tried that?
probably have because, we have gone camping and it's always rained
It's always
when we go
rained.
camping.
Yeah, it's a damp day here in Chicagoland. It's raining right now outside my window, and I'm thinking there's a pile of wood out there right now getting soaked. And if I was to try to start a fire right now, it would be very difficult to get started. I may
Mhm.
manage to get some smoke and maybe even a small flame eventually. And then I'm going to have to keep adding wood to that thing. And it's going to constantly be getting soaked, wet, being put out, and more so as more and more soggy logs get added to that pile, right? This is not unlike universal life insurance
Yeah.
and term insurance too, by the way. You never get that takeoff point that whole life insurance can give you. You never get that turnstile, that burn that kind of is all consuming. With whole life insurance, you have the ability to stop paying premiums guaranteed. There's a
Mhm.
word that we don't get to use very often in the financial universe. And the policy's cash value will continue to grow and not run out as you enter into your later years. Quick story, I was just meeting with someone yesterday or 2 days ago. He had a very nice $2 million um, universal life policy. Happened to be a variable universal life policy, but no matter. It's a similar strat. It's part of the 88% that we're reading about right now in the Wharton article. Which, if you want to put it up on the screen, Amanda, if you want to, don't have to. It's not like folks really are, I'm sure, thrilled to see an abstract from an article or whatever. But this is one example where someone who's very wealthy, has done very well for himself, and we looked at his projections for this universal life contract, and he had intended to use these policies for retirement income someday. But, unfortunately, he's going to have to continue to cough up money, adding wet logs to that fire for the rest of his life, or sacrifice a lot of his cash value out of that policy to fund itself, which means he's going to have a double pain. It's going to be raining on his retirement because he's going to be pulling more and more and more money out of the policy itself to fund itself. Why? Because universal life is inherently, essentially, it's a term insurance product with a side fund watching an index or tied to sub accounts that watch and are invested in the stock market. And so as he ages, he's going to see more and more, issues growing faster and faster. He's going to have less and less available to spend in retirement, and he'll never be able to stop paying on those premiums, even when he's 92 years old. And do you think at some point he's going to say, to heck with this and just drop the whole thing? Yes, that's the point. I think it's built right into the chassis of the product that they're selling. That's why 88%, if 88% of people using a toy or using it the wrong way, it was probably designed wrong, and so in this case, I would say one of the biggest reasons is maybe the insurance company, and the article here kind of promotes this idea. Maybe the insurance companies are actually designing universal life contracts in order to have them lapse. I mean, that's a great relief to the insurance company. What do you think, Brandon?
I mean, I think that the insurance companies, just like people are like, yeah, well, banks and insurance companies, they're just, they are businesses,
Mm-hmm.
right? And if they can create something that people will buy and they will make more money, if it's, assets versus liability, well, they want to have more assets on there. If anything, why it's hard for us to sell these whole life products is because it doesn't illustrate as well as those other ones.
Yeah.
However, I want to be able to say with high degree of confidence that my clients are in really good position. And I think that again, they run a business. They are foundational assets that I believe that we want to have in our portfolio as far as the foundational tools of whole life. But again, life insurance companies are a business.
Yeah, and particularly if they're stock-owned companies, they need to maximize shareholder value, not policyholder value. A little bit different for a mutual company in maximizing policyholder value. And then in this abstract, they talk about how consumers they don't fully account the likelihood of needing money during a future year, where policy loans come into account, and that kind of thing, and where people skip the premium oftentimes. Mark, you want me to scroll down here?
There you go. Yeah, page 7 of
Page
the
7,
PDF.
second paragraph?
So up to page 7 of the PDF. So go up 2 pages.
Oh, of the PDF, not of the thing. Okay.
Yep, and then second paragraph, middle of the page, basically. Scroll down a bit. There you
Here?
go. Yep, down at the very end of that paragraph, it says nearly 88% of universal life ultimately do not terminate with a death benefit claim. Right there, it also says 74% term insurance, 76% universal life sold to seniors at age 65 never pay a claim. So, the overall, that means if you're younger, if you're 50 or 40 or 30, your lapse rate is even higher, because think about it. The 76 percentage point for the 65-year-olds is bringing the average down. If the all age average is 88% failure, then and the 76-year-olds, or excuse me, the 65-year-olds are at 76%, that means if you're younger than 65 watching this right now, you're, statistically speaking, 90+% going to drop that UL contract before you drop, if you know what I mean. Now, later on in the article, it says the lapse rate for whole life insurance is generally way lower than that of term insurance and universal life insurance. According to a 2009 through 2013 study by LIMRA and the Society of Actuaries, the lapse rate of whole life insurance was about half that of term insurance. Half. So that's a big deal, guys. That's a huge deal. Now, if you want to see that, I can go get that pulled up for you. But
Yeah, you're good.
that's a big deal. Now, look at the Limera study, and I'll pull it up here when you want.
Yeah,
But
go for it.
if we're building a plan that's designed to succeed, which I'm all about. I mean, Keith Moan has taught me the phrase, "I don't want to be a co-author in failure." Then I
Yeah.
cannot, in good conscience, recommend somebody jump into something, an airplane, get on this airplane when 9 out of 10 airplanes are crashing. Not on my watch.
So can I ask you then why do people get into selling these things? And what is the point? Like for me, I think about this and I feel like I got into this to make a difference in the world. But I look in the financial world and I'm like, dude, are we just wanting to set people up for failure, or like do we care about people, or is there like I don't know what's going on sometimes whenever I think about, okay, somebody had to sell this and knowing the stats, do they not want to see that? Like I just I want to be convinced by somebody who maybe is a producer on the IUL side of why it's so amazing, because I see people saying it all the time. And but yet for me, I'm like, I'm not gonna put somebody in a plane that's gonna blow up like that. That just doesn't make. I'm not that type of person. But is everybody like that? I don't know.
Right.
What do you guys think? Like, do you know
Amanda?
what I'm saying? Like, it's a hard thing because I'm like, well, I could make more money doing it the other way.
Yeah, well, there's like if you look at an IUL illustration or a VUL illustration, and they have certain parameters of how they have to illustrate it. And if you ignore the guaranteed, maybe even ignore the midpoint, you don't have anything to compare it to. You're not saying as compared to what that 6, 7%, whatever they're allowed to show you at this point, every single year looks really good. And the death benefit's nice and high, like all those things. And like I know people that they have sold term insurance for years, and they look for people who have term insurance that's about to expire within the next 2 or 3 years, and they go and they sell them universal life policies to replace them, because they can take the same premium they were paying for the term and just for a little bit more start the IUL or the VUL, and then if they have extra, they could put it in there. But and all that thing. It's a really easy sale, right? And if you only focus on that one set of numbers, it looks really great. The problem is, and I hope we get to talk about this, those set of numbers are totally unrealistic. They don't factor in any volatility in the market. They don't factor in any increase in fees, and so on and so forth. And yet, like, if you don't know those things, you don't know how to compare it, you don't understand like what's really going on, then you're like, oh yeah, that looks great.
Yeah, well said. Well, let's jump into that, Amanda. I mean, let's not bury that lead. What's going on with Universal Life to look so pretty and yet be the snake in the grass?
Well, why don't you just jump on that, Mark?
Okay.
I
Well,
think you've got some things. Yeah.
I'm pulling up a bunch of research still. So,
Okay.
but I think, you're right. I think the fundamental flaw in the Universal Life, the fly in the ointment, so to speak, is that it's an increasing term chassis that most people don't understand when they're signing that document. In fact, there's a very, let's just say, well-known insurance product reviews guy. Okay, and he was recently at a deep advanced strategies session that we had with one of the insurance companies that we support. And he said these words, and I'm going to keep his name out of it because I don't know, it was kind of a private meeting. So he said, listen, I review universal life contracts and whole life contracts, and I'm product agnostic. And if you will, universal life could work. It is possible for it to work if everything works out perfectly, not this year, not this month, for your entire lifetime. If everything works out perfect, it might just work for you. But, and then the big but came in. You as insurance agents cannot understand how complicated this contract is and how many ways it can change on you and more importantly on your client. Because you cannot understand it, you cannot explain it to your clients. And if you're unable to explain it to your clients, that is a business liability for you to ever sell or offer or recommend a universal life contract. And I was shocked when I heard him say that. So, with someone of his stature, again, this is a well-known, folks in the industry would know his name if I said his name. Um, it was a shock to hear him say that. Someone who's so product agnostic and willing to review the benefits and costs of both whole life, universal life, variable universal life, all of the other kinds. Listen, guys, all three of us here are legally able. We have the licenses to sell universal life. If we really wanted to, nothing is legally stopping us from doing it. We have the credentials, we have the expertise. I just don't have I guess, the gumption or the digestional fortitude to feel comfortable recommending that sort of mess. I'm going to use that word for folks. I can't think of a now. Could there ever be an example where it might make sense? Maybe we'd have to talk to each individual person, and I know each of you guys are willing to sit down one on one and have a real advisory consultative conversation. But for the majority of people watching this and listening to this, it's just it's getting onto the airplane knowing that 9 and 10 of the one in front of you fell out of the sky. I just feel like that's the wrong way to go. So bottom line is, this is a chassis, a product that is built with the assumption of increasing expenses. And I'm going to show one to you guys just so you don't think I'm picking this up. But go ahead.
While you're pulling that up, I'll tell a quick story just to illustrate this for folks that need an example or want an example. So I was looking at a whole life policy for somebody that has an indexed universal life policy. I had not sold that to her. She bought it, 20, 30 years ago. She's in her 70s now, and she was starting to get notices. You need to pay more premium soon in order to keep the policy from lapsing. And so she had lost contact with the person that sold her that policy. So I volunteered to do a 3-way call with the life insurance company to try to get some answers about how much is the premium going up, when is it going up, how much, what's the projection there. And we got on the phone, and even the customer service representative at the life insurance company could not give us an answer. They couldn't tell us what the fees were going to be in a year or two. And I asked for we asked for the manager. We tried, as much as we could. Can you give us an idea, even a ballpark figure, what the fees are going to be in a year or two? Nothing. They wouldn't. They refused to do it. Compare that with a true bank on yourself policy. There are fixed costs or fees, whatever you want to call them, for the life of the policy. They can never go up without your permission. And I'm not going to give permission, right? Like, I don't know about you, for my fees to go up. Like, that's a pretty big deal.
Huge.
Can I share before you guys go into the thing? Here's something that really annoys me, and there's a lot of things that really annoy me. But when people say, "Oh well, I have one of those policies," and I see it in one of those bank and yourself type policies, and I look and I'm like, "That is not what we do." Or you see on the internet all of these people who are claiming what we do, or the Nelson Nash idea, and they're like, yeah, well, it's just like Nelson Nash said. And I'm like, no, he would never have done that. He even says it in his book that he wouldn't. And to see people who get the average consumer gets confused, and they see illustrations side by side, and I know that that's going to be a train wreck happening, but it's a 40-year-old, so they think they're going to live forever, and it's all going to be sunshine and rainbows. And I have a 70-year-old at the same time, and it really annoys me whenever I'm up against a sleazy person, I guess you could say, that is selling these things, and they're saying, I'm just like you, and they're not. And it really annoys me. So we are specialists in this, and let's show why we are.
You're right. All right, let's see if I can pull this in here just for a minute. May I share my screen?
Absolutely. Do you need?
All right.
There, I'll try to help you.
Okay, awesome. I actually want to give a new screen share. Can I share my Can I do a new screen share? How do I do that?
Let's see. I'll kick out the one that's there right now and then try it again.
All right. Yeah, there we go.
We are live, guys, so you can see us doing this live.
Did I do the?
This is why.
That's the one I want to do. There we go. Great.
And guys, while you're here, if you're listening, I know there's a couple of people listening. Comment in there, like comment some of your questions. We don't want this
Yeah.
to just be us bashing like IULs or any of that.
Mhm.
We just want to be educate our clients, educate people who are maybe considering this,
And it doesn't have
because
to
this
be
is
a
only your future.
question. It could be a comment. Comments are
Yeah,
welcome.
anything.
Mhm.
Yeah.
Stories.
A lyrical poem, whatever, you're interested in sharing with us, a recipe, I could definitely use, some, nice IUL recipes to throw some
Yeah, and
contracts in the pot to cook.
I'm sure in our
Or-
comments we'll get
maybe
some IUL people who.
Yeah, or maybe a cocktail recipe. It is
cocktail,
Friday
yeah.
afternoon. It's 5
That's
o'clock
right.
somewhere already.
Well, I was thinking,
Yeah.
these numbers are all cooked here. So how do we move my numbers or my video out of the way? Can we disappear our videos? to
I
see
think
some
I can put
numbers,
them
or-
on the side.
Oh, good.
There you
There
go.
we
Look
go.
at that.
Love it. You are the Steven Spielberg of live streams, Amanda. I love it. So, this is a gentleman who got a illustration, which is a big table of numbers like you see here, projections into the future. If you're looking on the far left of the chart here, there's the end of year 1, 2, 3. Here's the end of age. So he was 38 whenever he got this thing. His plan was to put $1,000 a month in, so 12 grand a year. And if you look all the way over at the far right, it says surrender value and death benefit right there. So it starts out with $6,800, 11,392, and so on down the page. They assumed an 8.38% rate of return, which is what, the highest legally allowed when they were selling this to this poor soul. And, it was after insurance costs, he was going to expect to receive a 5.78 internal rate of return after 16 years. So not bad for, tax-free, somewhat predictable cash accumulation. So he thought, like, wow, there's no downside in the market. It was an average rate of return of 8.38. Why didn't he get a pure 8.3% rate of return? Oh, the cost of insurance, right? And we can get into how there is no such thing as a average rate of return. But let's leave that aside for a minute. Now let's fast forward after 16 years. How did he actually do? Let's take a look. So here, after 16 years, he's only actually seen a 3.8% internal rate of return. 3.8% internal rate of return. So he expected he would have, something a lot more than what he thought what he actually got. Remember, he thought he'd have something close to $359,000 or so. In reality, he only has $267,000. Now, anybody complaining about having $267,000? I guess not. But when you think you're going to get a whole lot more, $359,000, and you end up with only $267,000, you see at the bottom corner there, it tells me, what does it tell you guys? I want to ask you guys first. What do you guys think?
Lower number. That's what it tells me.
That's what it tells you. Okay. What does that mean though? What does it mean that there's such a big difference between promises and reality?
Something changed between the illustration and real life.
Mm-hmm. Yeah. Yep. Well, that's just it. There is something very different between the illustration and reality. After 16 years, and actually this was one of the best 16-year periods in the market's history as a country. We were off almost 16.5% from what he thought he would get. And of course, he was absolutely upset about it. And the only way you're going to know the end of this story is to hold on for dear life and pray that, something better comes along and you can get out of that mess. So there's one more thing, which is, loans on indexed universal life can also be a problem because when you borrow against an IUL, it doesn't continue to grow against the policy. All right. So unlike non-direct recognition policy loans for whole life insurance, you've got a broken system. Whenever you take money and borrow against your IUL, you're getting zeros on that number, or you're getting at least a wash. They call it a wash loan sometimes.
Yeah.
Can anybody explain why wash loans are not the same thing as non-direct recognition that you might see with bank on yourself type whole life insurance?
I'll let Amanda do that one because she's probably good at it.
Well, it's really fun to look at my policy loan interest and compare it with my growth and dividends every year and see how my growth gets bigger and bigger every year, even as my policy loan interest stays the same or goes down, depending on how much I'm using the loans. Um, if it were a wash loan, whatever I'm paying in interest, I'd probably just see that in terms of my growth.
Mm-hmm. Yeah, you have a wash, meaning you might earn 5% and be charged 5%. That's called a wash. But no one seems to remember that there are costs associated when you borrow too. You're still getting a fee for the entire cash value, a cost of insurance on the entire cash value. And I want to show that to you guys now just to give you a sense of what that looks like. At the beginning of one's life, here we are. I'll try to get this a bit bigger. There we go. So this
There you
is
go.
the cost of whole life and also a universal life chassis for someone who's 45 years old. Standard health ratings, $500,000 death benefit. The cost for a whole life policy is fixed and it's set for the life of the policy. Just like Amanda said, there's no way that they can increase those costs over their lifetime. It's contractually bound that is the cost. And surprisingly, wonderfully, look at that beautiful universal life contract,
It's
325
so
bucks a
low.
year. Yeah. I mean, imagine what all you guys could do with, basically $8,300 that you didn't have to waste on whole life insurance. What would you guys do with 8,300 bucks this year? I mean, maybe I would go and I could buy a hamburger every night, I could think of all the flat screen TVs I could buy.
Blueberry lemonade.
Blueberry lemonade,
Yep.
even better than
Okay.
hamburgers. Okay. So over time, clearly the universal life is way cheaper, right? Right?
That's,
Bueller?
I mean,
Bueller?
at 15 years, it's 5,800. Still,
Couldn't
the whole life,
because you're not
right?
wasting all this money on cost of insurance. You're going to either build up a lot of hamburgers and blueberry lemonade, or you're going to have a much larger looking cash value in your policy over time. And not to mention, you can get these beautiful rates of return from the index. I'm being facetious here, of course. That gives you these incredibly large projections, like our friend on the screen that I showed you previous. But give us a few more years, and what do we start to notice? Now we're in our 60s. And now all of a sudden, right when we need the policy the most, universal life is becoming more expensive than whole life insurance is. So what do I mean by when we need the policy the most? Well, many people are going to be pulling money out of their cash value policies in retirement, right? And what happens when you're taking money out of something and somebody else is also taking money out? Have you guys ever played Hungry Hungry Hippos? Yeah.
Yeah.
When everyone's grabbing, it gets desperate pretty fast. And that's what happens with universal life contracts. You're grabbing money for your groceries and your grandkids and your blueberry lemonade in retirement. And the insurance company says, no, that's mine over here. I'm going to grab a bigger piece of that this year. Doesn't this kind of feel like, and I'll hush after this, doesn't this table over here kind of feel like, you're in an apartment that you are locked into a lifetime lease and the landlord is able to charge the whatever rent he or she wishes. And because you're locked in that lease for life, you can never get out. And what would that maybe do to your ability to save for your own retirement needs?
Yeah. Again, I look at some of this and dealing with a 30-year-old who sees the illustration and isn't thinking about old them, and then a 70-year-old who's come into me saying, "What do I do? How do I get out of this?" And having those two conversations side by side is it's really hard because you want them to introduce and talk to each other, but you can't do that. But I'm thinking about it. I'm like, oh my gosh. And then they both freeze because or one of them's like, oh, I'm gonna go down that, and you're like, 30 years from now, you're gonna be coming back to me, or not, or you're gonna say our industry sucks, and I'm an evil person. But I'm like, no, I wasn't that person.
Sure.
And so helping those people before they're at 70 or when that rate is happening, I really want to help those people. But also I want to help the young people say, let's not buy a flashy thing that we think is going to be great, but it isn't. It's just what did the sizzle without the fizzle, or
Mm-hmm.
what do we call that? I don't know, fizzle with
Yeah.
whatever we call the title.
Right. And I feel like what a lot of younger people tell themselves is, I'm going to start with indexed universal life because it's going to have a lower cost now. And before those costs go up, I will 1035 exchange to a whole life policy. And that's there's a few things wrong with that. I'll let you guys add on to this, but one is for sure the insurability. You have to be able to, be approved for insurance at
Mm-hmm.
that time, and at what age you are is what the new policy age will be. What else would you say to counter that kind of plan? How can that plan go wrong?
That's a great one there, Amanda. If you're, thinking that you're going to jump off of this, you're driving this car as fast as you can toward a cliff, thinking that you could just jump out of the car and save yourself, and then the doors are locked and you can't escape. That can be a bad, situation. We also want to think about surrender charges. So when you go to cash that IUL out, you don't get all the money that you think you have in there, because it's possible that you're still in the surrender charge zone, which I don't know about you guys. I've seen them go out as far as 16 plus years before those surrender charges are gone.
Yep. And then you also, like, if we're setting up a true bank on yourself designed policy, you have to be careful that you got enough death benefit on the IUL, right?
Mhm.
Like, and that the new policy, if you like, that you can make that move, and like it's all, there's a lot of different things that can change, and if you want to
That's a
build
great
that
point.
relationship, have that person that is going to help you at that time. And hopefully that bank and yourself professional isn't going to sell you the same IUL policy. So then you've lost however many years of relationship with somebody that really wants to see you have a bright, stable financial future. Like, that's
Mhm.
a big deal, because, like, I know the power of the conversations we have with our clients, where we can help them, in so many different ways, not just with their policy. And to lose out on that relationship is also a pretty big deal to me.
You're exactly right. I mean, the one, you lose a bunch of cash value due to the surrender charge. Two, you're older, so you may not even, you'll certainly have a lower death benefit on your new whole life policy if you waited too long. And third, you might not get anything if you're uninsurable for any reason. So it's a risk. Are some folks taking that risk? Yeah. Might it work out for 10% of the population? Maybe so. But are you wanting to build your life on that risk? Isn't that the opposite of
Yeah.
what insurance is supposed to be?
Well, and I do think, again, as far as the industry, is we help people get up the mountain, and theoretically, and that we make some money along the way. But it's about getting down that mountain. And I
Mhm.
look at our landscape of people in retirement and saying, "Oh crap, who's helping those people?"
Right.
And honestly, I want to help younger people. I don't like saving people out of planes that are crashing. But I do want to help those people too if I can.
Mhm.
However, at the same time, if I can prevent them from getting on the plane in the first place, that's a better place, and to be able to land safely, because I feel like our world is at a place where we've all about this rate of return, all this other stuff, and we haven't helped people take care of our seniors or older people in general. And I want to be able to say, yeah, I care like for you just like I would my mother-in-law or my family. Like, that's how much I care, and I want to make sure that like her, I want to make sure you're you're living with dignity, not in a trash can.
Yeah, it was a hard thing when I saw my dad pass, for a lot of reasons, but I guess the disappointment might be the wrong word, but regret, let's say, of just mismanaging what could have been a final gift, a final kind thing to leave behind. And he had other great things he did leave behind, but there was just it's one more statistic that some insurance company got
Right.
all the money that he paid in all of those years, and the family got nothing out of that project,
Yeah.
right?
Yep.
So I know we're getting short on time here. Everyone, here's your a chance to put things in the chat. Make sure we talk about what you want us to cover. I'm going to share a couple of resources, and then I'll let you all to make some concluding remarks too. What I just shared, there's a lot of resources out there from departments of insurance, from financial literacy proponents about the different kinds of life insurance, term, UL, whole life, all those things. These two resources are from two Department of Insurances, one in New York and one in Texas. Choose which one you trust more or look at both, where they are clearly doing a public service announcement to make sure people understand the things to be on the lookout for when it comes to if you're going to buy some indexed universal life. And there's a lot of litigation going on around those right now. And I can see these Department of Insurance, Department of Financial Services wanting to get ahead of that and make sure there's not more litigation going forward, because that's more work for them. They don't want that. And for them to put out these warnings, that took them some doing, a lot of bureaucracy. I bet they had to get through to get that out there. So wanted to make sure to share those, so you're not just taking our word for it, and encourage you to learn the difference between term, UL, whole life, the different designs of whole life. You're not going to find much out there about paid up additions riders unless you're looking into banking yourself. But do that research. That's important to know those differences, be able to explain those differences to others. It's a huge component of financial literacy that a lot of people never learn.
Well, and financial literacy, like we should learn. I think that everyone should have a basic understanding of finances personally. Don't just delegate it to me, Amanda, Mark, or some other guy, but actually take ownership of your own financials. Don't go in, I don't know, with your rosy colored glasses, right? Seeing those things are really important, I think. So.
I would also say it's tempting when you've maybe watched this video to just feel like you need to throw up your hands and say, forget about it. It's worthless. I'm screwed either way. Or it's too complicated for me. I'll just blank, go back to the stock market or whatever else, you're the normal way, the crab bucket mentality. And I would say don't fall for that trap either. There are proven time tested strategies that I have found truly work, and don't fall for the fatalist what the heck mentality. I'll just rely on blank or whatever. Do your research and then take action. Don't spin your wheels forever. Apply those spinning wheels to the pavement to move yourself forward, and you'll feel better about this situation. You will have more and more confidence the more ground you cover. And now that our whole life policies, you guys have them, I have them, now that they've been in force even just a couple of years, even my youngest policies are really starting to take off. They are a true, like a pile of dry kindling that has really caught ablaze and has now become something that is growing in a good way beyond my own control. Meaning, even if I wanted to stop the premium or the cash values growth, it would continue to grow contractually guaranteed for the rest of my life. When there's nothing I can really do to stop it. The market can't take it away from us. Politics, madness in the markets, and yet your policies continue to march forward and become ever more efficient each and every year. It's a burn pile that I'd love to stay warm around for many years to come. And so I would say, it's also it's heartening to me as I read, I must be a nerd, I guess, because Wall Street Journal in 2022, Leslie Schism in December of 22 writes that the hottest thing in life insurance for more than a decade might be cooling off. And she's talking about index universal life sales of IUL. So, and I'll save you guys the details, but in essence, she says, hey, there was a dramatic rise, 33% year over year in the first half of 2022 of IUL sales, despite the market being down in 2022. However, in the third quarter, sales only went up 2%. So that's like a 10% or 1,000% loss. Let's see. Yeah.
Yeah.
And and now at the beginning of 23, the last point we have real full data for the whole year of 23, IUL sales were negative 4%. So we went from 22% up to 2% up to now negative 4%. Whole life insurance has basically stayed steady all throughout the pandemic. I'm looking here. Whole life insurance, actually, it's a positive 1% in the final moments of 2023. And whole life insurance represents 38% of the total market share. Okay. Whereas index universal life for the year 2023 only represented 23%. So we're seeing a tide shifting here. And this is according to premiums paid in. So there are more sales, more IUL sales, but there are smaller policies. Whole life insurance, there's 38% of the premium, but there's probably fewer policies being sold. So was what I take away from that. So what am I saying? I'm saying there are plenty of good, honest places where you can find a solution. You don't have to throw up your hands and think it's pointless. You can take care of this and rely on whole life insurance as a bedrock for your finances.
Yes. Love it. Thanks for those thoughts. I want to finish with a quick story. It's going to sound like it's a joke. So there was a universal life insurance company CEO and a bank and yourself professional golfing.
Wow.
And a true story that at least the person that told it to me claimed it was true. So I trust them. The bank and yourself professional said to the CEO, I'll bet you $100. Now you're going to think this is about who's going to hit the best next shot or whatever, but no, it's $100 that if you can show me a universal life insurance policy that's been in force for at least 10 years, that has outperformed the equivalent bank and yourself type policy, whole life policy, I'll give you $100. And guess what? The CEO would not take the bet.
Wow.
That's a pretty like
mic drop.
Yeah, done.
Mm-hmm. Wow.
That's a pretty big deal.
Well, Amanda, thanks for suggesting this topic. I know there's lots more, and I know that this will be up on the interwebs for a while. So I hope people stumble across it and reach out and have a discussion. How can they find you guys?
Oh yeah, well, Brandon, maybe you can post the link in the chat. Obviously, we are here on YouTube at Wealth Wisdom Financial. If you want to find our website and schedule a call, it's wealthwisdomfp.com. F is in financial, P is in podcast.
All right, you guys are always great for being able to be a great resource. So guys, definitely check out their podcast, their website, their YouTube channel. I'm at notyouraverageFinancialPodcast.com. I keep the name really short. It's just notyouraverageFinancialPodcast.com. And it's great being with you guys and being part of this revolution with you guys.
Keep up the great work, Mark.
Awesome. And as you guys are going through, keep learning and educating yourself. And don't forget, like and subscribe. If you're a hater and you like IUL, well, skip this video. I don't know. Whatever.
No. Tell us your handle, and we'll build a whole marketing campaign around your handle, and we'll monetize it. That'll be great.
There you go.
Monetize the haters, man.
Okay.